If banks continue to fail and they have to continue to liquidate assets, I think the Fed would have to do the natural thing and stop pumping interest rates to stabilize the economy. These next 2 to 3 months are going to be they're going to determine a lot of where we go going forward.
Let's just jump into the meat and potatoes. Where are rates right now, and what the heck have they been doing?
Yeah, we've been in kind of a tornado the last couple weeks with the bank news, with new funding programs announced, a lot of crazy stuff going on. But one thing that I really want to draw a lot of attention to is how we can get them lower and how you can take advantage of some cool new programs. Right now, rates are going to hover, depending on your credit, probably be between 6.25 and 7.5, depending on, FICO scores, down payments, all that good stuff. One big thing that recently changed is there's now what are referred to as LLPAs in the industry, which basically just means an adjustment to your loan, right? More points to close it is how you can think about it. If you really read between the lines here, they're punishing people who put larger down payments down, which is very interesting. And there's less of an adjustment for people putting 5% or less down. When you mix that with maybe a buy down program that we'll discuss in this episode, you can take advantage of some pretty sweet gray areas in the pricing spectrum here on mortgages, and really set yourself up to succeed.
Okay, I gotta ask, why is it that people are being punished that are putting more money down? Is this just an unintended coincidence, or was this something that was done on purpose?
It's hard for me to answer that, and I know that's a cop-out answer, but I don't think people are individually being targeted. I do think the Fed has influence on, Fannie Mae and Freddie Mac and the people who come out with these adjustments. And I do think they're trying to cool the housing market, right? Inflation didn't do it. If anything, it helped, right? It pushed the market higher. These banking collapses, we're not really seeing, it's still fresh, but we're not seeing that there's a huge withdrawal away from mortgage-backed securities, which is one of the things that dictates where rates go. And people are still very interested in real estate, especially when there's a concern about how their money is going to do in the bank. Right? They need to get it into a real asset. You saw crypto do pretty well last week. You saw real estate continuing to thrive in a lot of key markets. At the end of the day, I think it's not necessarily targeting people putting more down, but if you're trying to dictate a housing market, you tend to attack the subsector of people who have a bigger buying potential. And that happens to be people with more money, higher asset classes who are putting more money down. Whereas the first-time home buyer, Fannie Mae and Freddie Mac still want to allow homeownership to be a real achievable thing in America, while still targeting a demographic that may have a bigger impact on the housing market. And that's why we saw more of those impacts to the higher down payment percentage. But I'm going to share a cool little trick that you can use to actually take advantage of both.
What would you recommend people do?
This was actually brought up to me by one of our partner lenders, and I think it's brilliant. So to just add a little bit of clarity here, guys, if you're putting down 5%, there's about a 1/4 to a 1/2 point adjustment. A point is 1% of your loan. Little adjustment on that, whereas the 20% down option is about a 1.5 to 2 point adjustment. It's almost 4 times the amount. If you're working with us, this is something that we'd recommend, but one of my lenders brought it up and they said, if you put 5% down, and this is assuming it's a primary residence, you can't put 5% down on an investment property. If you put 5% down, but you were originally intending to put 20, you get the better rate for the 5% down. And within the first 60 days, call up your lender, take the other 15% that you would have put down and make a bulk payment on your mortgage. Now you have 80%, what's referred to as loan to value, right? You put your first 5, you finish up with another 15. When you make within the first 60 to 90 days of your mortgage, when you make a bulk payment like that, you can request what's called a recast. A recast can potentially get rid of your mortgage insurance if you had some. It can also reassess what your monthly payment is going forward. So they will base your monthly payment on the remainder of your loan balance. So it's as if you put 20% down on your purchase, but you didn't get the loan level pricing hit for the 20% down. You got the 5% hit, which is less, and you can still have the mortgage of a 20% down payment.
Let me see if I understand this right. What you were saying is when you put 5% down, the loan is a little bit cheaper as far as the closing costs involved than when you put 20% down, which seems a little backwards. It typically wouldn't work that way, but that's the way that the lending industry is right now. So you can get a cheaper loan if you're buying a primary residence by putting 5% down. And if you didn't want to keep all that capital in the bank, you could put the remaining 15% that you would have put down, bring it in after closing, which we call recasting the loan. If you say, I want my principal and interest payments to be redrawn up based off this new principal balance that's less. Now, you don't have to do that because you could just put that 15% down against the principal and just like get ahead on your mortgage payments. Is that correct?
You could, absolutely.
But if you ask for it to be recast, then they say, okay, your payment was going to be $1,800 a month. We're going to switch it now. It's only going to be $1,500 a month because you brought the rest of the money in, but you'll still have gotten the cheaper pricing on the loan, right?
Correct, 100%. And you can take advantage of both sides, right? You can get the bigger down payment with the monthly principal and interest. You can also get the better pricing with the lower down payment.
I recommend people have a banking relationship with a person with. You want to have like a mortgage broker who is aware of these checks, because if you just walk into Bob at Wells Fargo or Tom over at whatever your regional bank is, they're likely just offering you whatever products their bank happens to have, that they heard about in the training last Tuesday when the manager sat down and said, here's the special that we're going to be running, and that's what they offer you. Then you got to go shop to a bunch of other lenders to find out who's got the best deal versus going to one person whose job it is to know what every other lender has and what the best deal is for you. Any other benefits that you can see of talking to a broker, or any other pieces of advice that you would give people who are meeting with a broker about ways they could save money or questions they should be asking?
100%. I mean, at the bare minimum, brokered loans on average are less in points than retail. We don't have, the banks don't inherit the marketing fees and the office expenses and all that. So we get the wholesale rates, so to speak, because their overhead is less with us. We don't get a salary from Wells Fargo or Bank of America, right? We work for the buyer. We're not an employee of the bank. And we can also pitch banks against each other and potentially get the best situation for you. But ultimately, it's staying up to date with the market, being creative. Like this new program, it's brand new. The LLPAs just were announced, this month, right? We're already finding ways to combat them. We're already finding ways to try to get our clients the best information, the best advice, the best guidance to put them in the best investment position, right? And the last thing I'll end on is if you partner what we just shared there, the 5% down with a recast, along with a potential buy down. And this isn't the buy down in historical terms, which just means pay points to get a lower interest rate. There are really unique buy down programs that were rolled out as a response to the interest rate increases. Typically how they work, and obviously reach out and let us, discuss your specific situation. But there's what's referred to as a 3-2-1, a 2-1, or just a 1. All that means is that let's say your going interest rate is 6.5%. That's what you would get today if you close the loan. If you were to roll out a 3-2-1 buy down, your first year would be 3% lower. So if you're 6.5, you're going to be at a 3.5% interest rate your first year. Your second year, you're going to be at a 2% lower, a 4.5. Your third year, you're going to be at a 1% lower. That's a 5.5. And it wouldn't be until year 4 that you would actually be paying that 6.5% interest. Pretty unique option, right? What would I tell you if you can get a 3.5% interest rate right now? One important thing to keep in mind is within the next 4 years, should a refinance opportunity present itself, you never paid 6.5%. You got a loan and you never paid that agreed interest rate. You refinance within that first 4-year term. A couple important things to note is that with most of these products, it does have to be covered with seller credit. The realtors of you out there who are listening, if you're negotiating a $500,000 purchase price, go get 3% seller credit, right? Maybe offer $515,000 and get $15,000 seller credit. There's some different tricks that if you're interested about, reach out to us. We can help you navigate through the negotiations. But that partnered with the 5% down, man, you can get a really competitive rate in an environment that otherwise is not very friendly to interest rates right now.
Now, this is different than an adjustable rate mortgage, correct?
It is not an adjustable rate mortgage. That's a very important distinction, is that it's a temporary adjustment to your loan that after that 4th year would be 6.5% the remainder of the 30-year term.
Which is what it would have been anyways, right?
Correct. Yeah, it's a temporary, short-term, intermediate savings paid for by the seller that if you were to refinance, those funds that you saved are technically still sitting there for you as well. So you can use those to help you refinance and potentially have a $0 out-of-pocket refinance in 2 or 3 years.
It's magic what happens when you get your mortgage person and your real estate agent on the same team, and your agent can negotiate for you in a way that will save you money based on information that your mortgage person gave. This is why we talk about wanting a core 4. You want to have these people on a team. You don't want to just scotch tape a bunch of people together and think that they're all doing the same job. It's really good to have people on the same page. Now, Christian, let's talk a little bit about mortgage rates and where they are going. What are some scenarios that you can see for the rest of 2023 with what you think is going to happen with mortgage rates? To
bring some context, everybody, we're recording this literally the week after that Credit Suisse just got bought out, and 2 weeks after SVB collapsed. So a lot of uncertainty in the industry right now. So take this with a grain of salt. But if I had to whip out my pseudo crystal ball, two things to look for, and I'll give you the result of each. If banks continue to fail and they have to continue to liquidate assets, I think the Fed would have to do the natural thing and stop pumping interest rates to stabilize the economy. Now, we go back to risking inflation. If we do that, which in the short term would be bad, long term would probably cause the Fed to continue their interest rate increases after the stabilization. However, if these new funding programs coming out, this one's releasing, we just recorded a previous one where I talked about the bank term funding program, check that one out. If those programs have a positive impact and continue to push the confidence of banks into investing into mortgage-backed securities, that will have a positive result. When there's more buyers of an asset, the terms get less competitive because they don't have to incentivize it as well. That should lead to mortgage rates falling. We'll see what happens, but those are the two things to look for. The bank term funding program, the BTFP, which just came out, how the implementation of that happens, as well as the continued, hopefully no more continued, but potentially continued collapse of banking, of local, regional, and nation banks going forward in the next 6 months. And once again, we're recording this at the end of March 2023. These next 2 to 3 months are going to be they're going to determine a lot of where we go going forward. But those are two things to look out for to dictate where rates may go.
Fantastic advice. And we want to hear from you, the listener. What do you think about what we're seeing here? What questions do you have that I didn't ask? And what would you like to see us talk about? Leave that in the YouTube comments below. We read those and we will incorporate that into future episodes. Christian, if people want to find out more about you or want to talk about getting a loan, where can they find you?
Our website, theonebrokerage.com. There's a little apply now button. You can also email us at intake, INTAKE, at theonebrokerage.com. Rep will respond to you within 5 to 10 minutes if it's on a weekday. We'd love to help you out. Reach out for advice, guidance, or a mortgage application.
All right. And I have David Greene 24 on social media, davidgreen24.com online. Or if you're into Discord, you can talk to Christian and I by looking up the server DG's World, where we talk about this stuff every day. All right, Christian, thanks again for being here. Appreciate your time. I'll see you on a future episode.
Absolutely. Sounds good, David. Thanks for having me.
If you guys have a little bit more time, check out another BiggerPockets YouTube video. And if not, make sure you subscribe to the BiggerPockets Real Estate Podcast, where we talk about this stuff all day, every day.